today is to look at three things. One, we're going to look at the disclosures that are required under the Indirect Method. Second, we're going to look at IFRS, which we are, it's important. IFRS is a very big part of practice, a very big part of the CPA exam, so we need to know some of those nuances and really the major differences. And then we're going to start chapter 9, where you're going to get into some familiar territory, accounts receivable. Then we just follow with all things that you've seen in intro, receivables, inventory, client assets. So a few surprises, of course, with intermediate, but pretty much what you've seen, we're just going to build on that. So let's start with the disclosures. And if we just go back to what we looked at last week, I'm not going to go through the problem again, but we do have the information. So if you take a look at the income statement for our sample company, which is on, again, we're in module 6.4, and this is page 1. So this is the income statement. And I want to point out a couple of things. One, what was the income tax expense, and what was the interest expense for our company? So the interest expense was 10, and the tax expense was 21. Here. We also know that we did the cash flow statement, and in the cash flow statement, we know that there was a planned asset that was purchased by issuing a long-term note. And that information was provided on page 2. So when we look at the equipment, we have notes paid. Use that in just a minute. And then finally, when we did the cash flow statement, we used the indirect method that would be your primary responsibility, and we found out that there was no tax pay or no interest payable. All right, so we're just gathering the information because we did, obviously finish it on Thursday. Just want to get that information back up on your radar screen. So what we need to do after you finish the preparation of the statement of cash flows on an indirect basis, you are now required to provide the following disclosures. Now, the disclosures are different from the direct method, but we're only going to focus on indirect. And these are the 3 disclosures. You have to calculate and show interest and taxes paid. Number 2, you'd have to disclose any significant non-cash investment and financing activity. I think I mentioned even in the video on Sunday when we did the review that Johnson & Johnson had that right below the statement of cash flows, but that can go into a footnote as well. And then finally, we have to provide a definition of cash equivalents. So those are the 3 disclosures. Now, are you responsible for disclosures? Yeah. So on an exam, you might be asked to prepare the disclosures under the indirect method. So let's go ahead and do the first one. And the first one, supplemental disclosures for the statement of cash flows. Where do they go? So what did Johnson & Johnson do? Johnson & Johnson had, right below the cash flow statement, they had interest and taxes paid, significant non-cash investing and financing. Does it have to go there? No. I think I mentioned on Sunday that it could go where? It could go into footnotes. It could go into long-term debt footnote. This could go into the equipment footnote. So that information could be spread throughout the financial statements. So in this case, this is what you would have to disclose. Interest and taxes paid, definition of cash equivalents, and investing in finance. All right, so first, interest paid, taxes paid. So let's take the formula derivations. How did you get, let's start with taxes paid. How did you get that number? The way it would work on a direct basis, and by the way, these are direct method calculations. These are direct method calculations. That's the only direct cash flow that you'd be responsible. Income tax expense from the income statement was what? 21. You would subtract a decrease in tax payable or you would add an increase in tax payable. In this case, tax payable increased by what? By 20. That represents taxes you didn't pay, and therefore, the cash paid for taxes is 1. Cash paid for taxes is 1. So let's see if it makes sense. You got tax expense of 21. Your liability for tax went up by 20. That means you only paid what? That's the logic. Or the unpaid portion is 20. Now, for interest expense, we talk about capitalized interest in, I guess, chapter 10 or 11. But any questions on the tax? Any questions on the tax calculation? Yeah.
I'm not exactly sure what it says, increase by 1.
Well, it came from the balance sheet. So let's go back. So you'd have to go to the balance sheet itself, and if you go to the balance sheet, which is right here on page 2, accrued taxes payable went from 30 to 50. So that's given to you in part. I also took it from the cash flow statement that we just completed, which is on page 4. So you see it right there on the screen. I got highlighted.
Money?
Other questions?
Yeah, turn that on. Don't attest that.
All right, so that's your income tax paid. What about interest expense and interest paid? It's the same thing. You don't have to do anything here, because you don't have anything, but it would be interest expense is 10. You would subtract a decrease in interest payable, or you would add increase in interest payable. But you have nothing in that case. So cash paid for interest is 10. So those are the only two formula derivations that you're going to need for the direct method. And that's part of your disclosure. You really needed to do nothing for the interest because you didn't have any payable, but just in case you did, that's the way we're going to do it. So think about the logic, especially with the tax or even the interest, any expense. If the liability for that expense goes up, you didn't pay for it. If it goes down, you paid for it plus some of last year's, if you're paying down the liability. So think about your credit card. If your credit card drops, that means that you paid for what you bought this year and some of last year's. I mean, the order could be a little off, but nonetheless, your liability drops. So you got more cash going out than your expenses. If your liability goes up, expenses were not paid. So that's the way. So any questions on disclosure item number 1? Any questions on this first item? All right. Yeah. For the direct method, indirect, right? Yeah, well, these are the disclosures for indirect. So you gotta show interest and taxes paid, definition of cash equivalents, and significant non-cash financing invested. If you use the direct method, obviously you need to show interest and taxes paid, show that you have that. In the direct method, which you're not going to be responsible for, but the disclosures would include definition of cash and cash equivalents, or cash equivalents, significant non-cash financing and investing, and instead of interest and taxes paid, you would have to show this reconciliation. So you'd be responsible under the direct method to show this portion of the indirect. So that this would be a disclosure for the direct method. So the only difference is that for the direct method, you substitute interest and taxes paid, and you would show that reconciliation. But as I said, it's not very common to see the direct method. It's something you need to know. You'll pick more of that up in Intermediate 2, but for now, we just want to make sure you know the indirect. Any other questions on this example so far? So let's go back down. And yes. All right, so that's it. So any other questions on that? Okay. Now, why do you think that disclosure is there? I mentioned this on Sunday. I mean, why do I have to show you interest and taxes paid? The reason for it is the definition of operating activities. We define operations in a way that's not correct. Operations should be what? Earnings before interest and taxes. This disclosure is there for one purpose, and that is to allow a user, now you don't have to, this is not a disclosure, but this is how the disclosure is used. It is going to enable you to offset or add back the interest and taxes paid. So this number, 162, is cash EBITDA, which means cash earnings before interest, taxes, depreciation, and amortization. So what this means is that it's earnings before interest, taxes, depreciation, and amortization. And that's a cash flow measure that an analyst could use. Now, using our cash flow measure, the 173, it includes what? Interest and taxes, which violates the definition of operations, right? Now, I know a lot of us have been having trouble, like, what's continuing operations? What's operations? What's EBIT? So it's a moving target, but for US GAAP accountants, operating activities is not the same as operating income because it includes interest and taxes. So the purpose of the disclosure, and I keep saying this, I want to be sure that you understand why you're doing something. I mean, certainly if you just memorize it, that has to be disclosed and plug in the numbers, but how is it going to be used? And the application here is that someone will use this information and convert the accounting operating activities to a more financial analyst measure of operating cash. So that's the purpose. By adding back interest paid and taxes paid, you are able to take those out of the cash flow measure and get a pure measure of operating cash flow. All right, so questions on that, on the purpose of showing that disclosure. Now, the rest of this is pretty simple. If you were doing this as a problem, your disclosure would have to say something like this. Equipment with a value of $22 million was purchased by issuing a one-term note. That's it. You just need to tell the reader what are your non-cash events in the financing and investing activities. And then the last disclosure is just a definition. So you would have to tell the reader that this company defines cash equivalents as short-term, highly liquid investments with original maturities of 3 months or less, or were purchased on a date with 3 months or less to maturity. All right, so to finish this problem, if this was an exam question, you'd have to go through the cash flow statement and show the disclosures, and that would be the US GAAP solution. All right, so questions on that? Any questions on the cash flow statement? Again, I highly recommend that you look at the virtual office hours from Sunday. Then we did another problem. We added some things in there as well that might be useful. We do have I have other questions that I can give you, and I will before the next exam. I'm not worried about any of them. We want to go through the retake first. But anything on this before we go to IFRS? That's our next item up. Our objectives for today. Now, IFRS, by far, is much better than US GAAP. Just overall, in the case of the cash flow statement. Not always, but for the most part, cash flow statements are much more intuitive under the options that you're given under IFRS are much more intuitive. So let me summarize these here. So a good summary table would be the best way to do this. Interest and dividends received. Where are they under US GAAP? Interest and dividends. Operating, investing, or financing. US GAAP, we're operating, right? So interest and dividends received are called operating cash flows under US GAAP, which is pretty much nonsense from the financial analyst standpoint. Under IFRS, you have a choice. You could put them in operating or investing. The investing is more theoretically correct. So these are cash flows from investments in stocks and bonds, right? Equity and debt investments. So if this is IFRS, you have a choice. You could put those in operations, or you could put them into investing. Now, one of the things I like about IFRS, as I said, is that they're sometimes more intuitive, more logical. What I don't like is sometimes having a choice, because cash flow statements are a little different depending on what the management of the company decides. Right? So some managers can say, I want it in operations. And that could be for reasons that maybe it's a big part of their operation. Now, of course, if this is a financial service company, obviously interest revenue, like let's say for a financial service entity like an investment bank, maybe a commercial bank, maybe an insurance company. So financial service companies clearly have operating cash flows from investments. But if you're a manufacturer or a commercial enterprise, this is peripheral, right? You invest with excess cash, and you invest maybe on a available for sale basis. And if that's the case, then it probably does belong in investing. Now, the choice, I think, is there so that managers can decide what best fits their operations. Right? If you have those investments and you're using them, even if you're a manufacturing company, you use those investments as a mainstream source of income, that becomes part of operations. If not, it's investing. All right. Interest expense. US GAAP interest expense is operating. IFRS could be operating or financing. Financing is more theoretically correct, but how do you argue? How does someone in IFRS argue that interest should be part of operations? Well, it could be that operating cash flows are needed to pay off interest. Go back to the beginning of this chapter. We did the operating cycle ratios, and we looked at a company that, okay, in our example, it had excess cash to need to borrow. But what if you had a shortfall and had to borrow on a short-term line of credit? Do those loans come into operations? So what if in your operating cycle you're not getting cash fast enough, and you have to borrow on a revolving line of credit, almost like a home equity loan, where you got to borrow? Is that interest part of operations? Well, yeah, because you have to pay for inventory, and you need to pay for that inventory, you have to borrow. So again, it could very well be the case that those financing cash flows should be operating in that regard. But IFRS gives you the choice. US GAAP, there is no choice. It has to be in operating. Dividends paid. US GAAP, here's the job. Financing, right? Financing. IFRS says you could put them in operations. That's rare, so they're pretty consistent with US GAAP in this case. And then finally, income taxes. US GAAP would call this what type of cash flow, how would you classify it? Operating cash flow. Under IFRS, could be operating, and again, it's probably most likely in operations because that's where you would be paying for the tax, and that's probably the biggest source of taxation, correct, your operations. But they do give you an option. You can take the tax and allocate it to each category. So you can determine how much tax is paid due to operations, due to revenues and expenses and cost of goods sold and everything else that goes on the income statement. You could also find out how much tax you saved, let's say from interest on your financing, and put that in financing activities. You can determine how much tax you paid on the gain from the sale of a planned asset and put that into investing. So you can allocate the tax. I'm not going to show you that, but you can allocate the tax in each category. Now, what I will show you is a sample of what you might see under IFRS. And this could have gone on the cash flow statement, but it is a footnote. And notice what they're starting with. They're starting with a line item. Let's make this a little larger. They're starting with a line item that is profit before tax. So that's net income before tax. So they've already taken the tax out, right? And then they go down and they make the adjustments. Remember, there's the two sections of the cash flow statement. There's the non-cash revenues and expenses. So you add back depreciation, amortization, any write-offs, any gains and losses from, you subtract the gain and you add back the loss. You would add back share-based compensation and so on. And then what they did is they will adjust this as follows. The first thing they do, and I highlighted this in bold, number one is that any income that you earn on investments are subtracted. So they're taking out the income from investments. They're taking out the dividend income as well, the 800 here. And they're adding back interest expense. They're adding back interest expense. So what they've done is they've taken profit before tax, and tax is gone. Then they make the same adjustments we do, add back depreciation, amortization, non-cash losses, changes in inventory, we'll see in a second. But they'll subtract out interest income, dividend income, and add back the interest expense. Exactly what you did if you were an analyst using a US GAAP footnote that we saw before. And then the rest of this is pretty much standard. So they now take the second part of the cash flow statement, and these are the changes in operating working capital. So increases in inventory, subtracted, receivables go up, you subtracted, keep sales you didn't collect. So this number, cash generated from operations, that is a pure cash EBITDA. It's a pure cash earnings before interest, taxes, depreciation, and amortization. That is the number that we needed to get by using the footnote information. So it's already in a better presented format than the US GAAP. Now that is only a footnote, but that is earnings. This is, again, the cash earnings before interest, taxes, depreciation, and amortization. And that is a footnote to the financials. Now, they could have done that right on the cash flow statement if they wanted to. They decided in this company that I'm using as a sample, it's a hypothetical company, but they're using that as an example in the footnotes. And they're also giving you more information here about cash flow from sales. They also tell you this is a non-cash sale, right? They issued stock in exchange for securities of another company, so that's a non-cash event. That's a non-cash. Very much like this. In that case, that would debit your investment. Let's say it's in a subsidiary company, and you credit common stock. Whatever the number is. It's just telling you that a non-cash transaction took place. We issued common stock to acquire a subsidiary. How does that work? I issue my stock, I give it to you, you give me your stock. I take your stock, I dissolve it, your company's gone, and you merge with mine. And you hold my shares. So that is a swap of shares. It's a common way to acquire another company. And finally, last thing I'm going to do is actually prepare the cash flow statement. And the rest of it looks pretty much the same as US GAAP. So here's the cash flow statement in this example. Notice they started with the information from the footnote. So again, that's the cash EBITDA. Then what they did is made the decision. Should interest be operating or should interest be financing? They have the choice. This company decided to take the interest out in operations. But they're still giving you, what's good about it is that they're giving you the number that you would want, the cash flow on a pure operating basis. The pure operations will generate that cash. Now, they decided to put interest in operations and taxes in operations. Again, they could have allocated this to each component. Now, still not what we would call operating cash flow because of the following. In this company, we decided, everything else is the same in investing and financing, but this company decided to call interest and dividends received investing cash flow. Those would have been where on the US GAAP? Operating. Those would have been operating cash flows under US GAAP. We have them in investing here in IFRS. Now, for your purposes, you would have to be told what the company decided to do. I mean, you're going to need, obviously that table, you'll need to know your options, but if this was a problem, I'd have to tell you. Right? Because otherwise we have 80 different answers. Everyone can decide where they want to put these. So you would have to be told what the company decided to do. That they treat interest received and dividends received as investment activities. Well, I just want you to see the difference. We got to cover IFRS again. It's a critical piece of the material. And I'm pointing out the key differences, as I said. When there are a lot of similarities, it's no need to do it, but in this case, there's a very big difference in US GAAP and IFRS. All right, so that's all we want to say for cash flow. As I said, Module 6 contains information that we've already covered, the annual report. The only thing there, maybe the audit statements you'll pick up in an auditing course, but we've already covered management's discussion and analysis, of course, footnotes, so we've covered all that. So we're going to move to 9, but before I do that, questions on the IFRS cash flow statement. Any questions on the IFRS statement of cash flow? Or anything on it? Yeah. We did. In the, if you look at the video, I got them all explained there. And I put the answers on, I think on the Blackboard announcement. Right, so they're over there. And the reason why I'm not going to do it on the videos is I want to take our time and see that. And you still could ask them. All right, so anything else on cash flow? All right, so make sure you go through the question in this module. Make sure you go through the self-assessment, which is explained on the virtual office hours, and go through, and you're right, these are good questions in the back of this module. Take a look at some of the questions there, and I'll give you more examples. Definitely. All right, if there are no other questions, we're going to move to 9. So we're going to do that. Chapter 9, as I said, is going to be, I think, somewhat familiar. Some new material is going to be in there, obviously, on the intermediate level. In 9, our primary topics are going to be cash and accounts receivable. We'll see some of the basics in accounts receivable, which is in Module 2. But for now, let's look at Module 1. In Module 1, we know what cash and cash equivalents are. The main thing to worry about in this chapter, the difference that we haven't covered yet, is restricted cash. For the most part, you would think that cash is always a current asset, and it's always included within the cash account. We'll find out that cash can be restricted for use. It may be separated from regular cash, and believe it or not, cash may be a long-term asset. Cash may not necessarily be a short-term asset. And then the most important piece of this that moves into the intermediate topics, as I explained earlier, I'm going to keep saying this, every chapter starts off, you got to be careful when you read the chapter. It's going to say, yeah, I know this, I saw this in intro. It's going to take off to a different level. Where this takes off a little bit here, it's going to talk about cash discounts or sales discounts. Now, a lot of you were able to answer the question when we looked at those ratios, and I said, well, why would someone be able to, or why would this company be able to collect its receivables in 10 days? And you said, well, there's discounts, 210, net 30. You've seen some of that. Well, here's a new way of accounting for it. This comes back to what you'll see next semester in Chapter 8, which is the new revenue recognition standard. New meaning it's out there for a couple of years now. It's relatively new, it's quite different, so that will be an add-on. Now, let's talk about restricted cash. Oh, and by the way, of course, the other important point is that you have to know about bank overdrafts. An overdraft means, and you may know from a checking account, you've got overdraft protection sometimes. But under US GAAP, if a company overdraws, it is a liability. So bank overdrafts under US GAAP are liabilities. And under IFRS, they are netted out against the cash account. So bank overdrafts will be liabilities. If you owe the bank that deposit. And even the overdraft protection, what is that really? It's a line of credit. Either way. So that if you ever apply for overdraft protection, it affects your credit rating. I mean, they have to do a credit check, because if you get the credit card, it's the same thing. So An overdraft is just like a credit card, and it is a liability, and that's what US GAAP, for the position you take. Under IFRS, it is netted out against cash. Okay. Now, what about other types of restrictions? Let's talk about a compensating balance. What is a compensating balance? Well, depending on your credit rating, some banks, I'm talking about your as a corporation, so depending on the corporation's credit rating, a bank may require that if you borrow money, you leave on deposit a certain amount of money to protect the bank in case you don't pay, and that is known as a compensating balance. So a compensating balance is a deposit that must be kept in the bank for security on a lending arrangement. Now the question is the compensating balance cash? Is it a current asset? Or is it a non-current asset? And the way we will handle this is this time we're appealing to SEC requirements. And there is a difference if a compensating balance is legally restricted or not legally restricted. If it's legally restricted, it's like an escrow account. You can't touch it. If it's not legally restricted, you can use it, but you have to put it back at the end of a certain period. It's like borrowing money. So the question is, where do you report it? How is it reported? And what is it going to look like on the financials? Well, first of all, in the first case, if it's legally restricted and it is held against short-term debt, that cash is a current asset, but outside of cash. So what this would look like is, if I had cash that is legally restricted, it's on a compensating balance, if it's held against short-term debt, you have a restricted cash account. So in current assets, that is separate from cash. Okay, so let me remind you, let me do this, make this as clear as possible. In the current assets, you're going to have cash, and then you'll have restricted cash. If it's held against long-term debt, so if the compensating balance is for short-term debt, in the current asset section, you've got restricted cash. If the compensating balance is for long-term debt, current assets have cash, non-current assets would have an account called restricted cash. So in this case, it is a non-current asset. So if you look at the balance sheet, you're going to see cash in the non-current asset section of the balance sheet. So, relatively logical. If the bank requires that you keep the cash on deposit, legally restricted as collateral against short-term debt, it is a separate current asset called restricted cash. If the bank requires that you have a compensating balance held against long-term debt, then cash is on the current asset section, restricted cash is non-current. And finally, if it's not legally restricted, you keep it in regular cash and you make a disclosure. So if it's not legally restricted, that is, you can include it in your operations, but you have to make sure you put it back like a borrowing arrangement. So if it's not legally restricted, you include compensating balance in cash. In the cash account, and you've got disclosure. So again, if it's legally restricted, held against short-term debt, it's another category of current asset. Against long-term debt, it is a separate item. Cash is non-current. Not legally restricted, you simply make the disclosure. So here's an example of an application of this possibility. Let me just move this out of the way, make sure you can see that. Any questions on this? Again, it's an SEC regulation that we follow. Yeah. I'm sorry.
So you said that under short-term current assets, it'll be, and it's legally restricted, you'll have a
Yeah.
cash account, but it says that it's segregated on regular cash and
Yeah.
balance sheet, so what those line items?
Yeah, so here's an example. So if you look at, what's that like? So this is the gap. And you notice that they've got cash and cash equivalents, but down here in current assets, they got a restricted cash account.
But wouldn't that be for, long-term liability?
No, if it's long-term, it would go down here. So this restricted cash is held against the short-term liability, so that's the point. Is the compensating balance for short-term debt that you borrow, is it for long-term debt? So if you borrow for short-term periods, then this is only restricted for a short-term period. So if the loan is, 90 days, then the cash restriction is only for 90 days. So it's a current asset. If the loan is a 5-year loan, the restriction then becomes a 5-year restriction, and that would be part of non-current assets. That makes sense. So if there were long-term debt that required a compensating balance, this restricted cash would go down into the non-current asset section. So you could find cash as a long-term asset, depending on the agreement.
So this is something that you can use for borrowing,
Yeah, it's collateral, essentially it's forced collateral. Now, that'll raise your interest rate. In other words, if you borrowed $10,000, but if they said you gotta keep $1,000 in the bank, you only got $9,000 to use, but you're still paying interest on the 10. Right, so your cost of borrowing goes up. So it's a way that the bank has security, but they also raise their interest rate now.
So
You can't touch
so
it.
eventually, you're not really putting, having $1,000 restricted cash, and pretty much it's just like get deducted out of the loan.
Yeah, that's one way to look at it. But if this is called a compensating balance, that's the way you have to look at it. Sometimes the loans are discounted up front, and you walk out with money. Either way, it's the same thing. It reduces your
when we look at it from the interest aspect, you're right, like, you're
Yeah.
paying a lot more money for.
Yep, so you have less cash to use. If you can't use the 10, you can only use the 9.
That would be a restriction.
The restriction is, they want that on deposit. Now, you could have used your own money on deposit and used the 10,
Well, then-
it's the same thing, it's the same thing. I mean, sometimes the bank can deduct it right away, it's like a discounted loan, otherwise they'll say, well, you have to open up a bank account immediately.
Would this be just for companies that don't have like credit worth? Like, they're not
Yeah,
credit
it
worthy?
depends on your credit rating. Yeah, it depends on your credit rating. So all of these restrictions depend on your credit rating. And in this case, well, we know Gap had, I guess, some financial problems. This was an insurance, here's the disclosure, and they say that the restricted cash, 41 million and 38 million, represents cash that serves as collateral for insurance borrowing and some currency swaps, which you'll learn in finance, but they borrowed from insurance companies, and that's restricted from withdrawal. So it has to be separated from regular cash, because it's restricted. Another important point, look at the year ends. The year ends are late January or early February. Makes sense? Yeah, because it's a retail store, and that's when their sales wind down to almost zero. Because even in January, you have after New Year sales, so you're still operating at a pretty high level of volume, and then all of a sudden, retail sales will drop. So they have a year end, not that it's a calendar year end, but the year end coincides with their business. The other thing I wanted to show you down here, this is a subsequent event. You have to disclose, you'll learn this in auditing, you have to disclose subsequent events. So there is a period, so when you do auditing, you're gonna find out that the year end is January 31. You're gonna go to the client in February and March, probably release these statements in April. In February and March, before the statements are released, things can happen. And those events, if they're significant, have to be reported. And this is known as a subsequent event or a post-balance sheet event, and that's disclosed on the financial statements. So it tells them that they settled one of the obligations. So there's an example of restricted cash. All right, and by the way, the statement of cash flows will include, even though it's restricted, you would include this, so when you're doing your, and you have, again, it's a nuance for practice, not for, classroom environment on the exam, but this restricted cash would be included with cash and cash equivalents when doing the cash flow statement. So you would add this together, so for purposes of the cash flow statement, you would put this together. You would have 1756 in cash, you would add those together, for cash flow purposes. All right, so that's the restricted cash. Okay, so any questions on the rules or the requirements? Any questions on the application and disclosure? Let's do another application. Look at the ratios at the beginning of chapter 6. What would you do if you're calculating a certain rate? What ratio would you think that this would affect? We looked at operating cycle ratios, receivable turnover, inventory turnover, accounts payable turnover, the working capital ratio. Which one do you think would? Working capital, yeah. I mean, if I'm doing working capital, I can't use this cash, right? So that's why we use the quick ratio also. So you probably exclude this, but that's why it's there. So once again, why make these disclosures? What's the purpose of the disclosure? And we talked about matching maturities. Do I have cash available now to pay off current liabilities? This cash is not available to pay off current liabilities, and that's why it's earmarked as restricted. All right, so a lot of finance and intermediate as you see. All right. Any other questions or comments on restricted cash? All right, the next topic, as I said, is going to be a little different than the way you might have seen it. We know we've got sales discounts. You also have trade discounts. So let me, all right, so what are trade discounts? Trade discounts you don't account for at all. They're like volume discounts. Most corporations offer those. So, in other words, if you buy 40 or more, we'll give you 5% off the catalog price or the list price. So, a volume discount is really a reduction of list price, and that determines the selling price, right? That determines the selling price. You may know yourself, if you're ever looking on like Amazon or something like that, you go to search for something. So you go online, you're looking for, I don't know, a plastic container to store stuff, right? All of a sudden, what comes up on the screen? If you buy 10 or more, and you see like 10 of them stacked up, you get, $2 off each or something like that. That's a volume or a trade discount. That's a trade discount. And that establishes the selling price. There's no separate accounting for a trade discount. You don't have to do anything. That's the selling price. So if you went on Amazon and you ordered one plastic container, it could be $10. If you order two, they're $8 each. So that's the price. It's $8, and that's the way you do it. Now, sales discount. That's the 210 net 30. That is a reduction of the invoice price for early cash payment. So this establishes the invoice price. So it determines the selling price, determines the invoice. The selling price. This is a reduction for early cash payment. And you know the terms, you get 210 net 30. I think you know what that means, right? You get a 2% discount if you pay within 10 days. If not, you have to pay the full amount. Kellogg's just gave you an example, trying to always give you some practical applications. Kellogg has 210 net 11, net 15, net 16, so they're very interesting terms. But the question for us now is how do we account for these discounts? And the new requirements tell us that, I'll put this on the screen, and I'm also going to write a few things on the board. We've got two approaches now, which I know you didn't cover an intro for a lot of reasons. One, because it's an intermediate topic. Two, because I'm not sure if the standard was passed at the time you took the intro. So we got something called most likely amount. I'm just going to give you a side note on that expected value method. What you're going to find is that the more recent GAAP standards are using probability weighted values. It's, when you cover stat, or I don't know if it's in business research methods, I don't know where you see it, but you get expected values. And that's what we're using. So we're using more probability weighted values in accounting than we have done in the past. Now, what the most likely amount method is something you already saw. That's when you can either show the sale price or the discount. You can account for the gross method. Under the gross method, you assume the discount is not going to be taken. Under the net method, you assume the discount will be taken. You may have seen this. Depends on how it was covered. So the gross method assumes that the discount is not going to be taken. You record the sale of the gross amount because you think you're going to collect what? Everything. Right? That's the point. You think you're going to collect everything. Under the net method assumes the discount is going to be taken, again, because it will be recorded net of the discount. So under the gross method, you assume that, as you can see, the discount is not going to be taken, and therefore, that's your expectation. Under the net method, you assume that the discount will be taken, most likely. That's the most likely amount. So the whole idea of this approach is, what is the most likely amount? The firm, without giving any probabilities, says the most likely amount is the gross amount of the sale. Discount not taken. Other company might say the most likely amount is what? Net of the discount, because the customer normally takes the discount. And that would be based on experience, and of course, as audited as what would you do, you'd have to verify that that is in fact what's going on with this company's history. Now, when you look at the gross method up on the screen, it means that if the customer doesn't take the discount, then you got what you thought, and really there's no real difficulty on collection. If the customer does take the discount, now you've got to make the adjustment. And there's an account called sales discounts. I don't know if anyone remembers, but the sale discount is a contra revenue. When you go on the income statement, you remember seeing sales minus sales returns and allowances and sales discounts. This will be the contra revenue. The discount will come off. So a separate sales discount account is going to be recorded. So the logic is the most likely amount, no discount taken. Discount not taken, you're good, right? Nothing happened, you got what you thought. If the discount is taken, you got to reduce revenue by the contra account sales discount. Now let me show you, this is the theory. And always the theory is up front. Under the net method, we assume that the discount will be taken. So, number one, if the customer takes the discount, nothing to do, right? Customer takes the discount, don't have anything to do. If, however, the customer pays after the discount period, does not take the discount, what happens? Well, you got more money than you expected, correct? So let's say that this sale, let's say the sale was 100, and you have a 2% discount. You thought that the customer would take the discount and pay you 98, right? 2% discount. Now they give you 100. You got $2. What do you do with it? It's interest income. So you treat it as revenue. So under the net method, if the customer does not take the discount when you thought they would, you've got what we call interest income. There's an account called sales discounts forfeited, and that becomes revenue. Sales discounts forfeited will become interest income. All right, so now we're going to do an example. And that should take us through the end of the period. We'll pick up on Thursday with accounts receivable. All right, so that's the theory. So let me now reinforce the theory by giving you an example. So let's take the illustration. And this is one, I think this is one of the ones that's in the book as well. Sometimes I'm using those, sometimes I'm not. But I think this one's in the text. And this is showing you the most likely amount approach. So it tells you that Clark and Lewis sells hiking boots, and their selling price is $100 per pair. On June 1st, the company sells 50 pair, and the terms are $210 net 30. The customer pays for 20 of them within the discount period, and 30 of them after the discount period. So let's put this on the board. The gross amount of the sale would have been $5,000. And then we'll see what happens if you take 20 within and 30 after the discount. Let's see how you would record that.